Welcome back to the deep dive. Today, we're going deep on something I know a lot of you are thinking about, how the Fed messing with interest rates changes things for those of us who like dividend stocks.
Yeah, the Fed gets everyone talking.
It really does. And to help us really get into it, I like to have some real-world examples.
Always good to have something concrete.
Exactly. So we're looking at an article today a listener sent in all about Kinder Morgan.
Interesting company. A lot to unpack there.
For sure. So to kick things off, the article talks about how the Fed lowering interest rates is a big deal. Could you break that down for us? What does that actually mean without getting too jargony?
Sure thing. Basically, when the Fed lowers interest rates, it's like they're making it cheaper for companies to borrow money. Think of it kind of like a sale on loans.
Okay, so if Kinder Morgan, for example, wanted to, say, borrow money to build a new pipeline, which they're actually looking into, according to this article, would it be cheaper for them to do that now?
Exactly. And that can mean a huge incentive for companies to invest in these big projects, which can lead to growth and, since we're talking dividends today, potentially bigger payouts for investors.
Music to my ears. Speaking of, the article mentions Kinder Morgan's dividend yield is currently sitting at 5.3%. Now, I gotta say, that definitely got my attention. But I also know a high yield doesn't always mean a good investment. There's gotta be more to it, right?
You're absolutely right. A juicy dividend yield is definitely tempting, but it's super important to understand the why behind that dividend. A company needs to be able to actually afford to pay that dividend without putting itself in a risky financial position.
Which is where free cash flow comes in, right? I've heard that term thrown around a lot. The article mentioned it too. But to be honest, I'm not always sure what it really means.
I hear you. It can sound a bit intimidating, but it's actually pretty straightforward. Think of it this way. Free cash flow is basically the cash a company has left over after paying for all its essential operating expenses. It's the money they've got to play with, whether that's reinvesting in the business, paying down debt, or, as we're interested in today, paying out dividends.
So it's a good indicator of a company's financial health, right? Like, can they actually afford to reward investors without going broke?
You got it. And in the case of Kinder Morgan, understanding their free cash flow is extra important because, and the article pointed this out, they do have a pretty substantial amount of debt. So their ability to generate strong and consistent free cash flow is key for both keeping that dividend flowing and pursuing all these growth opportunities we've been talking about.
And speaking of growth, the article did mention Kinder Morgan is looking at a lot more than just pipelines these days. We're talking increased domestic oil and gas production, even LNG exports. That's liquefied natural gas, for anyone who's not familiar, a major player in the global energy market.
Huge. And it's interesting. They're not just sticking to oil and gas either. They're dipping their toes into biofuels infrastructure and even looking at ways to provide power to data centers, which eat up energy like crazy.
It's like they're diversifying their portfolio, which, if I'm following you, kind of reinforces the whole don't put all your eggs in one basket idea when it comes to our own investments, huh?
Exactly. Diversification is key.
So Kinder Morgan, they're branching out, trying new things. That's got to be a good sign, right?
It's definitely interesting, but I will say this. Even with all this potential, there are always risks, especially in the energy sector.
Right, of course. There's always got to be some risk.
Exactly. And one of the big ones for a company like Kinder Morgan is that whole energy price roller coaster. You know how it is.
Yeah.
Always up and down. Now, their pipeline business, it's not quite as vulnerable to those price swings as, say, an oil drilling company, but it still has an impact.
Yeah, that makes sense. So if energy prices take a nosedive, could that mean less demand for pipelines?
Exactly. And that's where all that due diligence stuff comes in. Remember, we were talking about that earlier. You got to look at the whole picture. What's the company's financial health like? How much debt are they carrying? How are they managing these kinds of risks?
And speaking of risk, we got to talk about renewable energy. Everyone's talking about it these days.
Yeah.
How does that whole shift impact a company like Kinder Morgan? They've been all about fossil fuels for a long time, right?
That's the million-dollar question. No doubt the energy world is changing fast, and investors have to figure out, are companies like Kinder Morgan keeping up? Are they changing with the times?
Because they've got all this existing stuff, pipelines and all that, which isn't going to just vanish overnight. But they've got to adapt if they want to stay in the game, right?
Absolutely. It's a tough balancing act for sure. So what should investors be doing? Well, get your hands on those financial statements, see what their sustainability reports are saying, and listen carefully to those earnings calls. Are they putting their money where their mouth is when it comes to renewables? Are they investing in ways to move cleaner energy sources around? That's going to tell you a lot about where they're headed.
It's like they're at a crossroads. Stick with the old ways or forge a new path. Big decisions.
And those decisions are going to have a huge impact on their bottom line and how much investors could make. That's why it's more important than ever to stay informed, be ready to adapt, and really do your research.
So much to think about. We've covered a ton of ground here. The Fed, interest rates, Kinder Morgan's whole deal, their dividend, even the future of energy. Big picture. What are the main takeaways our listeners should walk away with, especially if they're thinking about investing in Kinder Morgan or any dividend-paying company for that matter?
I think the biggest thing is realizing that things that seem totally separate, like the Fed messing with interest rates and a company's dividend, are actually connected. When the Fed makes a move, it ripples through the whole economy. You got to see those connections to be a smart investor.
It's like a chain reaction, right? One thing leads to another.
Exactly. And another thing, that high dividend yield, as tempting as it is, can't be the only thing you're looking at.
Easy to get lured in by that shiny number?
No kidding. It's like finding a $20 bill on the sidewalk. You're excited, but you got to make sure it's real. Investors need to go deeper, look at those financials, see how much debt the company has, how much cash they're generating, and whether that dividend is sustainable in the long run.
So don't just scratch the surface, dig deep.
You got it. And last but not least, don't forget the energy world is in a major transition right now.
It's a wild ride. So how can listeners stay ahead of the game with so much going on?
That's the real challenge. Be picky about your sources. Don't just listen to one person, read one article, or follow the crowd.
Think for yourself, right?
Exactly. Do your own research, find reliable sources, and be ready to change your investment strategy if you need to. The energy landscape is shifting fast, and staying informed is the best way to manage risk and jump on new opportunities.
It's like they're trying to, reinvent themselves a little. Kind of like Madonna, always changing it up.
Yeah, there are definitely some parallels there. But look, the bottom line is whether they can pull it off.
And what are the big things to watch for? I mean, how do we know if they're actually making the right moves?
Well, the article mentioned biofuels, which is a start.
Yeah.
But you really got to go deeper. What are they actually putting money into when it comes to renewables? Are they figuring out how to move things like hydrogen around? Because those are the kinds of things that'll make or break them in the long run.
So it's not just about talking the talk, it's about walking the walk. Actions speak louder than words. Right?
100%. And that actually brings up an interesting point. It's something we haven't really touched on yet. Think about this. How much do you think global politics play into all of this?
Ooh, good point. Because Kinder Morgan, they're not just operating in a bubble, right?
Exactly. The energy industry, it's global, it's political, things can change on a dime. So investors need to be aware of that bigger picture.
So much to keep in mind. We've covered a ton of ground here today. The Fed's moves, interest rates, what's going on with Kinder Morgan, dividends, even the future of energy. It's been quite a ride.
It really has. It's always fascinating to see how these things all connect.
Absolutely. And I always learn so much from chatting with you, so thanks for that.
Anytime. Always a pleasure to be here.
And to our amazing listeners, thanks for joining us on another deep dive. Remember, knowledge is power, especially when it comes to your hard-earned cash. Keep those questions coming, and we'll be back soon to tackle the next big topic. Until then, happy investing.